Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone again. We're just seeing people trickle in a few seconds until our official start time. Today is Monday, March 24th. Here's some disclosures. We're going to share a few more in the chat. It's great to see everyone again. And a couple weeks ago, we outlined some levels, and those are exactly where we've come now. And I need to find out what's next. So we have been talking about, we did a trading view idea back on the 12th. Actually, I'll share that also in the chat. And we basically identified the level where the S&P is sitting right now. So, all right. Yeah, actually, just go ahead and share this with you guys. Now, if you go to tradestation.com, wait a second. If you go to tradestation.com and go to Insights, a second. And then you go to this blog post. Some of the points we're making are in this blog. Something strange happened, actually. Let me try and share this with you again. All right. And then this was the blog post we had done at that time. Stocks may be oversold. You can see back we did this on March 12th. The S&P was pulling back to a level we had noticed was a weekly support, and basically we had identified this price zone up here. And we talked about this also on State of the Market. So just to point out, that we had, it's a combination really of the calendar analysis or the calendar considerations and the technical considerations, basically realizing that the narrative had the potential to change with the NVIDIA event and the Fed, and we had noticed it at that time. We had noticed how the weekly level was coming into play, and now we have this bounce. So if you look here on the daily chart, you can see that we've returned to that level right there. But now I've added something else. This is the Fibonacci of the actual move. This is the Friday when the market started selling off, the Friday, February 21st, down to the low on the 12th or the 13th, I'm sorry. And what we basically see is that we're now back to a 50% retracement and we're in this zone. So we went a little bit above the retracement, which is good news for the bulls. But at this point, you got to realize we're in a volatile market. There's a lot of news, sort of things that could be driving the market, a lot of tweeting, a lot of comments that could come out. So this is, I think, something we have to realize now is that in some ways the technicals matter less. It's really a question in many ways of simply seeing what kind of headline comes out or comment or anything else. It's difficult to really see. Like today, we got something that Trump was doing with Venezuelan oil that pushed up energy some. So just to realize that this is now an environment when you really look at this week, there's really nothing very important this week. We have PCE on Friday, but in my view, that's even not very important at this moment in time. I think right now we realize that April 2nd is going to be the big event, and that's really kind of what we're looking at when we're going to get this increased tariff news. So basically, in my view, I want to also say that the big thing I'm really actually I think might be the most important thing. Again, we might be back to watching the 10-year, the TNX, because the Fed last week basically did their quantitative. They took away some of their Q quantitative tightening, and yields went down for like a day. So I think we need to kind of also watch this here as being something that might actually sneak away and cause trouble for bulls in terms of stock prices, because yields held this level here above 4%, and we've been talking about it and it's been consolidating. But I want to kind of put that on the radar that in some ways this might be the kind of sleeper chart to keep our eye on. So the S&P and the Nasdaq are hitting resistance now at some levels we're going to be getting to. But first, I want to just quickly mention a few other things. My sense right now, or not my sense, but kind of the things that seem to be presenting themselves before me, as we kind of have about a week till the end of the quarter, then earnings season and stuff like that, is that in some ways we're now in a little bit of a period where we're hitting some resistance at some overhead levels. We have a bounce off the lows, and now we are into kind of a period of questions. Do we enter a stagflationary sort of period? And there are reasons to think we could be, for example, and I'm going to get to those, or does everything go back to being wonderful again? And, there's kind of just, those are the two splits. And on the bullish side, the positive side, I think we have to realize is there is a structural downward movement in inflation because of shelter costs. And that could just override all the bad stuff. And I think we have to realize one of the reasons why coming into this year, a lot of people were so positive was we were looking at strong earnings growth and falling inflation. Now, in some ways, those have not been totally invalidated yet. First quarter earnings was actually pretty good. Second quarter guidance is coming in weak. But again, a lot of people, they're going to be like, oh no, tariffs, let's cut guidance. Everyone does the same thing. But then when we get to the end of earnings season, it might not be as bad as people think. They're going to front load bad news, set a low bar that they can then exceed. This is what corporate executives do. It's just kind of the way things are. If they have a reason to be negative to basically take stress off themselves, they will, and they're doing it now. So I think we just have to realize is that there is still a potential here that some of the really strong stuff will come out of the woodwork, but there's also a potential stagflationary scenario taking shape that could be negative for some time into the future. So let me quickly mention what those are. Is it last week the Federal Reserve cut its GDP estimate? The GDP now from the Atlanta Fed is negative for Q1. It doesn't mean we will have a contraction in Q1, but it has slowed a lot. They raised their inflation estimate. And so those things are potentially, not terrific overall. There was a Reuters article today talking about how companies are cutting guidance and earnings estimates drop the most quickly in over a year and things like that. And we've been talking about this. We've been saying that in many ways, it would make sense when you see the economic numbers weakening and other stuff. Like we've been saying, this is just PR strategy, is that if companies can lower their guidance, they will. And people now are kind of expecting that we're going to see, we were previously expecting double-digit earnings growth in Q1. That is now completely out the window. So the question is, how bad does it get? How much below 10%? Now it's around 7.5% earnings growth in Q1. And now the thing is, how much do these estimates get marked down? That was a Reuters article today confirming what we've been actually mentioning for a few weeks. So then the other thing is that there are signs of things like with the supply chain causing trouble. Like there was an article recently where basically Walmart was going to the Chinese suppliers and trying to get them to lower prices, and the Chinese were refusing to do it. There's another article today, and I'm not sure where it was, but it was basically saying the same thing about Target. So the question now is, as we go forward, who's going to pay for the tariffs? Is it going to be the American public, or is it going to be the corporates, or is it going to be the Chinese or the international suppliers, wherever they come from? It's kind of like of the three, people, of the three parties involved, maybe they all take a hit. But the question is that if it's Wall Street, I mean, if it's Main Street, then that's bad for inflation. If it's corporate America, that's bad for earnings. So you kind of put those things together where of the three groups that can lose, two of the three impact the U.S. stock market. So that's just a question we don't really know yet. All is going to be worked out over a great amount of time. So far, this could just be, again, posturing or whatever, but there have been news articles put out, I think it was put out by the Chinese media, saying that they're refusing to lower prices for American companies. So these things are just something to kind of think about here. In terms of what this is going to mean as we get into earnings season, as guidance starts coming out and companies start talking about the impact of tariffs. This is going to be a major area of anxiety and concern likely for investors and for strategists overall. Last week, we saw Micron have weak margin guidance, which followed the thing from NVIDIA. We saw Nucor, which is a cyclical steel stock, basically have very weak guidance, and they plunged there. A company like this should be benefiting from tariffs, and they did just the opposite. They cut their earnings estimate in half. So I want to just kind of mention that. We had FedEx had bad report as well. So these things are kind of pointing that direction. Another company I think we should kind of watch, which a lot of people don't pay attention to, but Cintas is a major company that does uniforms, for employees. And this is a company that in some ways has been a kind of an economic I think indicator of the labor market. So the last earnings report, it gapped lower, and it was a very interesting thing because this has been running for a long time. Now, this is not a highly traded stock, but it is a very important stock because in many ways, they probably represent a fair chunk of the American labor market in terms of people, employee uniforms. They really dominate the space. So, gap lower, and let's just see what happens. The next earnings report is coming up pretty soon. So this is one I think we might want to kind of look to see, like, where do they see the labor market going? Now, today, the manufacturing report showed more inflationary pressures, and they actually said, oh, the competition is preventing companies from passing through the cost. But what does that mean? It means bad for profit margins. So I think those are all things that are out there. Now, again, these are things that can just go out there. They can kind of, sit there like a menacing sort of, monster that just fades away. That's what a wall of worry does in the market. And I think now this is the spot we're in where the market has had a bounce. There's positives, there's negatives, and it's a very more now just range bound sort of environment that we've gotten into technically. I will also mention that of the overall sectors I've looked at, the ones that seem to have the most potentially constructive chart patterns are XLC, as we have talked about a lot, and XLF. The energy thing we had talked about now is maybe not so clear because now we have the Middle East situation is not really escalating. We have a bump today in the Venezuelan news, but again, it's not that much that is really clearly pushing in one direction. So the thing I said about energy, I think, it kind of played its way out, and I'm going to be maybe just saying now it's very unclear. The last thing I wanted to mention was, and I might do an idea on this, but I'm going to just share with you guys, is Merck. This chart is maybe now something people might see as potentially a negative. It's just want to throw it out there. MRK, just a little thing to be kind of aware of. And one other thing to just think about is gold. Will gold hold 3,000? I mean, it went above 3,000 and it's coming back down and it's sitting right at that level. So I want to just kind of share that. Now, in fact, I actually forgot. I need to share with you guys the standardized returns of some ETFs. Let me just quickly put this up on the screen. You can look at that real quick. Some of these ETFs we're going to be going through. And the last thing I'll mention is interesting before I get to the sectors is just the fact that I'm starting to notice that Bitcoin is giving some kind of early indications on the Qs again, on the NASDAQ. It seems to be moving before the, before the overall index, which is an interesting thing to be aware of. And sometimes it can be used. Sometimes you'll see that one chart moves before another, and it can actually kind of help anticipate other moves. So let's now get over to the weekly, the S&P, the main thing we look at. And so for me here, this is the weekly chart. So we don't have that zone on it. But what we do have is we basically have this level around, this was the top of our zone, 5773, 5773. It was the low from back in January. And what's interesting now is it was also pretty close to the close back on March 3rd. So this is now an area where I think we have to look at that where we're basically sitting right now is, I mean, if there's a place people wanted to kind of step in as sellers, this is more or less that place. This is the level that we had been talking about. Like I said, 2 weeks ago, it was pretty much the top of the range and we're sitting right in there. So this is now, I think, an area we have to look out for and see, Tuesdays have this tendency to be turnaround Tuesdays and things like that. So I think people have to realize here is that we are in a spot now where people, this bounce has now happened. It's hit the level we saw, and now there's, it's sitting at a resistance level and it's not going above it. I think the other thing we have to realize is we're going to get these, reciprocal tariffs on April 2nd. The question though is that something when people does the fear increase going into the event? And I think that's one of these things we're out there now where does the fear increase into the event of tariffs? Does fear increase into the event of earnings? And the news flow and the price action will tell us of that. But at this point, I think you have to realize we've priced in something of a bounce and something of a recovery. And now it's a spot where we have to see if we get more of that sort of negativity coming through from these macro things that are out there. I mean, the Fed cut GDP by a big chunk. I mean, it was more than half a percentage point. Things like that have effects on earnings. And that ultimately has a longer term potential effect on equities. So that's the S&P. Let's take a look at the daily again, just to kind of point out we're right at that retracement level and we're at this zone here. And so I think this is an area where we're also back at the 200-day moving average. So all those things suggest that we've kind of hit our upside target for now, or not our upside target, but a level we had identified. Now, going to the Qs, Qs also here at a spot where I think we got to realize that essentially this is potential overhead resistance to close from the first full week of March. And, it's a close, it's a weekly close. We're below it. And let's just kind of see from here. I mean, remember, this is by far, in many ways, the dominant part of the market. And the Qs here, really, when you look at them technically, this has, some pretty significant sort of, move to the downside and now potential upside. And if you look, people may still see some space down here. It doesn't mean that in a bearish scenario, all of this would be filled. But in a time of being range bound, This is the sort of thing when ranges get filled and things can move around and fill the ranges, and we could have a retest back down to these areas where typically the way something like this in my kind of experience would work out is that the last, if there is a trend to the downside, there will be a reassertion potentially of that trend, but it will be weaker. It won't be as violent, but it could be a lower low on a weakening, sort of trend, weakening momentum. Something like RSI will make a higher low, for example, as the Qs make a lower low on the daily, for example. That's often the way something will play out after a drop like this, and there'll be a period of time when it gets beaten back down, but the selling is not as severe, and then slowly the selling pressure abides, and then things go from there. So I want to just kind of point that out, that this is now a spot where there is some potential reason to see this as being resistance, and there is also potential space remaining to the downside. Now the Dow right here for me is also, this is interesting to see it at this high, and there's a weekly high that it's also potentially stalling at, and so I think we have to realize that the high from that midweek of March is an area that is serving again as a high today. And I just have to realize, just remind you, that sometimes Tuesdays are turnaround Tuesdays. So we've had a bounce here for the last several sessions, and that might simply create, some potential the other way. Now the Russell here, in my view, has really no really clear anything. If anything, I might want to target this low from here, but I don't really have a lot of clarity here on the Russell. It's kind of in this space. So I don't really want to overly emphasize any levels on this. In my view, something like the Russell, it's been hit so hard that this would be something where it often will simply follow the market, you know, a day or two later, or even a half a day later. So if the market does want to, weaken and stall, you could see people continuing to try and buy the Russell and say, oh, this, I want the small caps. I'm not interested in big caps, and it works for like half a day, and then the selling kicks in. So from my perspective, this is something that lags. And if we see the selling reassert itself, this would be something that could probably just drift and sit and then suddenly get hit. So that's the Russell. Now, like I said, the 10-year to me remains in some ways, this is in many ways the most important chart maybe we face right now, not only as investors and traders, but as Americans, is does the 10-year treasury yield, you know, continue this move that we have seen? Um, you know, Basically the 10-year treasury yield was in a downtrend for, since the early 1980s. And there are reasons to see it as having reversed to the upside. If you make this like a monthly chart, I mean, you can see that this is on the long term, I mean, this is now reversed higher. And the real question is, I mean, on the weekly here is really, does this longer term reversal, kind of continue? And there is reasons to think that the 10-year is the yield has more upside. The fact that we're holding this level here is something that is potentially kind of problematic. And so I think we have to realize is that, this is something that when you look at the Fed raising their PCE estimate, when you look at their unexpectedly, dovish move of cutting, of doing QT, taking it from 25 billion to 5 billion, which basically means that they're going to be essentially, I don't want to say buying more bonds, but on net, they're not going to be selling as many. Essentially, they're going to be, they're going to let them, mature, and they're going to reinvest more of the money than otherwise they're going to do. So on net, it makes them net buyers of duration. It makes them buyers at the long end of the curve, which should be keeping the 10-year lower. They did that announcement last week. It smashed yields lower for like the day or two. This was the Wednesday of the Fed. It came down, and it didn't even go back down under the low of March. So I think right now we have to just kind of keep our eye on the 10-year. There are reasons to worry that this may have a sort of upward trajectory. And if this starts moving back above 4.5%, it could start ringing some alarm bells. So seeing the 10-year yield move higher when the Fed is cutting QT and lowering their GDP estimates is a potential negative. And I think that that's one of the things we have to realize here is that was when I said there's things out there that are more structurally macro that are going to have that potential to weigh more. Now, materials here have had this very feeble little, bounce. But from my perspective here, we have a little bullish inside week, but we have the lower high on the weekly. And in my view here, this many people maybe just need to be aware of that this may be a lower high with the potential for a lower low, maybe back toward that low from February. So seeing the new core profit cut and things like that. I mean, that was it. I think I don't think many people expected to see that steelmaker. They slashed their earnings guidance in half. So I mean, to me, that really kind of said something. So for me here, when you look at overall GDP estimates coming down and things like that. Now, remember, a lot of the material stocks are things like packaging companies and things like that. They're economically sensitive. And this might be something where people see the risk of further downside. Now, communications remain what we have said is, one of the healthiest weekly charts. Communications and financials, we've been talking for weeks about the kind of structural uptrend in them, and they held the level that we've talked about. From my view here, people may see space back up over 105, back to the highs. And this is something I think to kind of watch. I'm going to just quickly mention that one stock that kind of grabbed my attention, I've been watching for a while, is Reddit. Came down and tested this gap from back here in October. 200 moving average, you can see kind of has a double bottom here. So this was kind of interesting to me, that I thought was kind of interesting, that I want to mention to you guys. Now, Reddit is not officially in XLC, but if it ever does end up in the S&P 500, it would be in this sector most likely. So I wanted to just kind of point that out. XLC continues its structural sort of thing here. It's the weekly chart, the structural upside, holding those weekly lows. This is, like I said, XLC and XLF have in some ways the cleanest weekly uptrends. Now, energy here is kind of interesting because it didn't break down. It has that value proposition, but at the same time here, it faces just a whole kinds of range bound stuff. So I think right now this is also kind of headline driven. And I think that the thing to remember here is that there is still more OPEC production increases coming. If the situation in the Middle East does not escalate, or something happens, I don't know what, but something to make people breathe a sigh of relief, energy here might, just go back into this range. So we had talked about this, the kind of apparent strength in it, the way it was starting to outperform, but at the same time, it's not really confirming a breakout here. So for me, I think at this point, when you really look at it, it's at 93 now, and the real kind of long-term high was at 98. So this might be something people, the easier sort of view might be, do we have the real juice to break out above 98? And that's really maybe when the real sort of bigger money would want to be engaging in this sector. And just to kind of watch and realize that, this thing really outperformed. The market selling off in the last month and a half, and energy moving higher. That should maybe catch some people's attention. The low valuations are potentially something that people are looking at. And then just to realize maybe this has potential, and maybe we should be setting some price alerts up around 98, 99 and seeing if we actually get a breakout. But until then, it's just on the watch list. Now, financials also here. This has a little bit of just potential resistance, XLF, around this kind of 50 level. There's some weekly lows here. And so for me, I think we got to just realize that this is kind of range bound. If you do a 50% retracement of this move, we went above the 50% retracement, which is overall potentially bullish. I think there are some things about this area that are, catching people's attention. There's probably been some real significant reallocation away from technology into financials. It kind of gained kind of new favor. However, it is also in a kind of range here. And, people, I mean, I'm not going to predict anything. I would never predict anything. I mean, I'm not going to, but there is some potential here. I mean, not even of it. I don't think the trend would even maybe be that sharp. I mean, that's a pretty sharp downtrend. But the thing is, if this does decide to consolidate, these are some big gains. And if people are worried about the economy or earnings or anything else, earnings season is coming up for these guys. I mean, just realize this might, fill this range and play in this range for a while. Even if people are bullish, they might look for some more consolidation here. Let's look at the daily chart of XLF also, because, I mean, at this point in time, it's under the 50-day. I'm just kind of looking at this. It's not really any kind of clear signals. So the weekly remains pretty healthy, but at the same time, this has been, people might look for just more kind of range bound movement in a name like this. That's XLF. XLI. Now, this is one that we've mentioned that it kind of remains in this channel. And we get into these ranges, things can get kind of agonizing because, the levels come out of nowhere that suddenly matter. That's why the weekly charts can be so interesting. It's why we focused on them. Now look at the close from back here at the kind of the weeks. I guess it was President's Day week in February. Look at that low. Look at how we've basically stayed under that low these last few weeks, and we're still under it today. So again, this is like a little inside week, and we have this downward channel. So from my perspective here, if this 134.31 level becomes resistance, this might be actually an area where people look for more downside in industrials. In my view, I just look at maybe the potential in industrials. The thing to remember is that these guys actually trade at high multiples. They're economically sensitive. They also have a lot of Defense Department exposure, which has been all kinds of uncertainty on that front. If you look at Lockheed Martin last week or some of the other things happening, a bunch of defense-related companies like Accenture and Gartner, took hits from the Defense Department cutting budgets, and we know that's going to be happening. So that's an issue. But the other thing is these guys have varying degree of tariff exposures. A lot of industrial products, they have different sort of components and things that are sourced abroad, complicated international supply chains. So from my view here, industrials have been a pretty strong sector, and they've had the support of a strong economy and probably a little bit more government spending support than people really realize. So I think we got to realize is that this might be a resistance level to watch here in XLI. XLK, sorry, XLK here. I mean, basically, this is also kind of like the Qs. There is some potential resistance across here. The weekly close from that week in March, the close was actually 218.54. We're like a few cents above it, but it also goes back to a weekly. I wonder why I put this level here back in September. There must have been a reason why I did that level. Is the weekly open? I think I put this level. I put it on because it was also near a weekly close, a weekly low, but what's also is that it now applies over here, this weekly close. So the thing is this level going across here was a weekly close, and now we're coming up toward it, and it also was near a low back here in September. So I think we realize, this has been also, sharply kind of sold off, and people might also look for some period of kind of retesting and consolidation in an area in something like this, especially when you look at the situation in Apple, because there have been some kind of significant market share losses in them. And I actually think that the Chinese companies Xiaomi reports soon, which who knows if they have good numbers, maybe that comes out and worries you about Apple. Consumer staples are trying to basically hold this level from here. From my view, this is something that isn't all that interesting or meaningful anymore. It did hit this level, and we had talked about it probably wouldn't hold, in a bearish market, that people wouldn't stick with staples, and that more or less played out. In my view, now it's holding this level, but again, not really something that may be all that interesting to a lot of people. Real estate investment trust here also just kind of sitting. And I think with the yields moving higher, this actually becomes something of a risk. It had this top of the channel, and people might still see some potential downside in this. So it had this big candle this week, and we're stuck inside of it now for the next 2 weeks. So we just, I think, have to realize is that the yields might be an important one on this. It could hurt it. Utilities are kind of in the same spot with yields moving higher. These are kind of stuck in a range. And if you kind of look at this on a longer term pattern here, we had kind of taken the channel off of it, but maybe put it back on. That basically, this is something where it's making this lower high, and it's just kind of drifting here. These are very tight sort of ranges. If yields move higher, this might be an area that struggles, and it still has that certain degree of AI exposure via the data center electricity theme. So this is healthcare, and what I think is interesting here about healthcare is that, if we get more into a fearful environment coming back, this one actually continues to have a kind of constructive sort of pattern. It held a 50% retracement back there, and then it went back down and held this level around 143.5, 144. So you can see this weekly move that had the rally and it held the 50%, moved up, came down and held it again. So this might be an area where almost it forms something like a kind of, trend line coming down with the potential to break out through it. So I want to just kind of mention that in healthcare, just to kind of look at this and see kind of where it's not anything all that strong, but I did want to mention you that this area, this has been a beneficiary of the overall environment of the fear trade, the weaker economy thesis, all those sort of things. And this might actually be an area that does reassert itself. We saw some pretty strong sort of rotation toward this earlier in the year, and that trend might not be done. The last thing is XLY, which is, really kind of the Tesla sort of related thing. And here it is at this weekly high from back here in March. So this high was around 203.22. Today, it's right at that kind of same level, a little bit higher, right around 202, 203. So I think we got to see, does this high from this week here become a resistance level, or does it have the juice to rally back up? So I think we have realized that this is at a pretty significant drop, and then there's going to be, people could be looking for, I'm going to draw a little shaded zone actually, which I think might be better, which would be more or less this. Basically the level that would be essentially the high of last week, of 2 weeks ago, and then this weekly close right there. So let's kind of see if this turns into some resistance on XLY. Remember, a lot of this has to do with Tesla. So those are the main things I want to talk about. We will be doing market trends as usual on Thursday. Remember, market trends, we look at individual trends, individual sort of things happening with companies and isolated pieces of news or interesting things happening in the market. In State of the Market, we focus on the indexes and the sectors. So great to be with everyone. I will see you on Thursday, 2 p.m. on Thursday. Thanks a lot.